From the morning reading, the SPY hits January 20 support at 181 and buyers appear again. OPEC to cut production? Perhaps. TRIP, CTL, CSRA, Cisco, EXPEO, gap up. All 9 sectors moved lower on Thursday. XLY, XLK, and XLE were the strongest sectors, while XLF was the weakest sector. Oil fell only 3 cents to close at $27.30, after falling as low as $26.05. Oil rallied after a report indicated that a UAE energy minister said that OPEC was ready to cooperate on a reduction in oil production. Breadth weakened as advancers led decliners 4.31 to 1 on the New York Stock Exchange, and decliners led 2.24 to 1 on the Nasdaq. Treasury yields fall to 3-year low as prices surge. That's really hurting banks and life insurers. Prudential tumbles. Money continues to flow into Treasury bonds, gold, and the Japanese yen. The Dow on the verge of a breakdown. According to the stock-bond ratio, stocks have entered a period of extreme undervaluation. The term valuation may be misleading, but whatever the semantics one prefers, the two markets are out of whack to an extreme degree. The ratio has exceeded 2.5 standard deviations every day for the past week, which is a rare condition dating back more than 50 years, and has been positive for forward returns, especially on a non-recessionary environment. Bond yields have fallen more than 10% over the past 2 weeks, while gold has rallied more than 10%. Going back 40 years, these kinds of moves in relatively tame markets have rarely been seen, and usually it is at times of crisis. Since 1975, there have only been 3 other times that both bond yields and gold have moved so far, so fast, and all 3 led to gains of more than 20% in stocks over the next year. Junk bonds have been hit hard again, and sentiment has followed. The 5-day optimism index for HYG has dropped below for the first time since last September of last year. Since early 2008, there have been 13 days when a 5-day average of the optics has been below 10. A month later, HYG was higher 10 times with a median return of 3.1% and a greater than 4-to-1 reward to risk ratio. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:03 a.m. Central Time, and I'm recording this in preparation for the market day of February the 12th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report, and once again, another big overnight, and this time to the bullish side. At the time of this cut, the S&P futures were up over 23 points, some 1.25%. Russell futures were much weaker, but still well up at about 0.75%. Nasdaq up about 1.3%, and the Dow futures up about 1%. Crude oil making a huge overnight move, up 5.3%. The euro is down about 0.4%, bonds down about 0.5%, and gold is down approaching 1%. And overseas action, China still closed. Hong Kong is down 1.2%. Japan down nearly 5%. Germany up about 1.5%, United Kingdom up about 1.5%. So some really wild gyrations going on in the overseas markets. In terms of macroeconomic reports for today in the United States, you have core retail sales. That was one of the big 2 for the week, along with Janet Yellen's testimony. So that will certainly be looked at before the market opens. Along with that, your retail sales and import prices. Preliminary University of Michigan consumer sentiment comes out during market hours. And also we have FOMC member Dudley speaking as well. Let's see. Let's go ahead and go to volatility. Obviously, yesterday, quite a bit of weakness. The volatility did pop. Short-term VIX is up over 27 at this point. Skew is still relatively benign. IV percentiles continue to climb in recent action. Now the S&P is at a 56. The Russell's up in that upper tier now at a 68. The Nasdaq is 64, and the Dow also in that upper tier at a 70. So we're getting to be in those upper levels of implied volatility. In terms of standard deviation moves based on a close to close, only one market turned that in, and that was the Dow, though there was certainly plenty of intraday action. And in fact, let's go ahead and go to the charts. We'll see yesterday, let's zoom in a little bit. Let's look at the big wick here. And in the overnight, you did have an undercut of the prior low. This is a 52-week low. And you take a look at the close. This is a 52-week low close. In fact, that goes back about 2 years on most of the indices. So this is still significant. Now you have what could be called a bullish reversal, where apparently the institutions continue to want to support this 1800 area, and yet at the same time it is the lowest close in 2 years. Now, so far today, this reversal pattern does seem to be following through, and we have a very, very strong bullish pattern coming in. Let's go ahead and look at the Dow. Same kind of pattern on the Dow. The Russell, same kind of pattern. You had a bit of a hammer, or perhaps a spinning top, depending on how you want to define that upper wick there. On the Russell yesterday, but the follow through is the same. You've got that bullish confirmation. And I think we didn't look at the Nasdaq. Nasdaq is actually probably the most bullish in terms of this pattern right now. And you see it had a doji, very, very long wick to the bottom side, and then a nice follow through so far on the overnight action. And this is pretty robust in terms of just how far this overnight action is. Now, of course, retail sales and other information could come in, and when all the cash participants come in, that could take some of this off or accelerate it, but we'll probably see more of a pattern like this one here, where you get a big long green candle. That's the first most likely probability at this point, unless new information kind of sinks this effort by the bulls to rally off this 1800 area on the S&P. In terms of volatility, as you would expect, we had a high close. In fact, there's only been 2 days prior to yesterday that had a higher close, coming down a little bit off of that yesterday. We also, on an intraday basis, also had a closed in on the 30 area. We've only actually had one close in the last 52 weeks that was higher than a 30. So volatility is certainly with us. And as a result of that, whether it's a bullish move or a bearish move, big moves are certainly very, very possible in this kind of a market environment. The other part of the news for yesterday is the bonds, and the bonds came in on an intraday 52-week high, and look at that pattern there. And this has just gone parabolic of late. The yields, of course, going the opposite direction and are setting multi-year lows, is my understanding. Crude oil also came in at a many year low yesterday. It has rallied off of that. And you see this, yes, indeed, yesterday at 26.05 as the low, and you've got to go way back many years to get down to $26. So the bottom is not in yet on the crude oil market. People keep thinking that it is, and it continues to leg down. It's not quite done yet, folks, and along with it, the rest of the crude oil complex probably not quite to capitulation yet. Let's go ahead and go to the daily report. And this continues to be about as weak as it can be. Phase 1 on the intermediate term phase opinion, that's bear flag territory. Though obviously in bear flags you can have big bullish rallies and often kind of rip your face off as the shorts get covered, just to turn around and then leg back down is the typical pattern. Marketing correction, accumulation distribution in the S&P is as ugly as it gets at an E. Nasdaq nearly so at a D-. GMI index remains a 1 out of 6 on the sell signal. Decision point scoreboards, no change here. Pretty much a sea of red with some neutral signals and a couple lone short-term bullish signals still holding on. In terms of position sizing opinions, no change here. Still at 0% for portfolio exposure for portfolio investors. Volatility, active traders still at less than 50%. Some changes here in the intermediate term market posture. We have turned severely bearish with a very bearish sentiment line. You notice the S&P down below a 20. Only the Dow remains above a 20. Nasdaq and Russell are just about as low as they can go. And certainly that we would have a bounce in this area is not a bit surprising. Hedge warning status remains a 2+. And with a close below 1800, we would take this to level 3. Doesn't seem to be in the cards for today at least, though I still feel that we're likely to undercut 1800 at some point and probably move towards that 1760 to 1750 on the S&P at some point. In terms of specific warnings, market in decline, sharp increase warning, VIX futures up over 18. Distribution day count still retains that marketing correction. Volatility ratio warning did fire again yesterday. We had a close in that upper window again. VIX phase has been increasing. The week out expected move is now at a 58. Still very, very high for the number of days that are represented in the week out there. In terms of new highs, new lows in the New York Stock Exchange, 586, nearly twice the warning level threshold of 300 on the new lows. Intermarket risk aversion indicators, all 5, are still flagging as risk off. Short-term sentiment for stocks, a 4, so pretty benign there. Medium term, a 3. Having a bounce in these conditions is certainly not a surprise. Fear and greed index also quite deep into the extreme fear, an 18, though a little bit up off the low score of a 16 yesterday. You see, we've been living this for a while. Notice that 1 month ago we were a 17. So while we have kind of rallied a few times and broken down and undercut a couple times in the last month, we pretty much are in the same place in terms of overall risk and volatility and sentiment in the market as we've been for several weeks. In terms of special opinions, option income strategies, cover calls, put selling, all 3 of these opinions are currently in the outside the acceptable window to initiate new positions for novice traders. If you're an experienced trader, you might want to take a toe in the water experience with taking advantage of this elevated premium, knowing that the odds of adjustment are very high and that you're going to need to account for larger than expected delta and vega moves. Make sure you have plenty of capital available. Consider some of the defensive postures that we mention here in the opinions. In terms of sector specific, it's a sea of red. Only utilities holding up, and it even started to show some weakness coming in. You know, when the market goes down hard, everything goes down, including the defensive sectors, including utilities and consumer staples. As you can see here, they're starting to really have to fight to hold up. And indeed, on the percent change yesterday, look at utilities down nearly 2%. Though holding up for the 1 month, 3 month, and year to date. And I think that's probably enough for today. And we're going to have a little bit shorter one. I'm going to go ahead and just scroll through this next section. If you have any questions about any of this, just hit the pause button, get the hyperlink, and then go there. You'll find more information. We really appreciate you subscribing to that YouTube channel. It's free. That gives you notice when the content is posted. Hit that like button while you're there. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. You see the hyperlink down here at the bottom. That will take you to the full set of disclosures. We'll see you back here perhaps Monday morning. I'm not sure if I'm going to do one on Monday morning or not. It's President's Day. We'll have a partial kind of trading activity in the futures market and so forth. So it technically is a trader's holiday. We'll certainly be back here on Tuesday morning for the market preview from Falcon Global. Good trading.